Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Jimmy Lee, CEO of Wealth Consulting Group, to discuss why investors should not try to time the market around a debt ceiling resolution. Jimmy, it's great to see you with us. Welcome to Trade Talks.
Great to see you, Jill. Thanks for having me on.
You got it. Why do you think the short-term treasury for long-term money trade has been a sucker's bet?
Well, with the Nasdaq being up, not quite 20%, but close, and S&P up about half that amount, it's far surpassed the returns of the short-term treasuries. And so if investors took money out of stocks or bonds and wanted a place for safety because they're concerned about a recession or a deep decline in stock prices, so far this year it hasn't worked out for them.
Are you concerned that the movement is really taking place as a result of, a handful of mega cap names? How concerned are you about the concentration risk in that move?
I'm a bit concerned about that in the sense that, we'd rather have a broader rally going on this year versus a narrow one led by the big mega cap names. But a lot of those names were down more than 50% last year in 2022. As an average, they were down a lot. So it's not surprising that those companies have led the market back, just because I don't think that in some cases those companies should have been beaten down as much as they have. But going forward, I think even in a slowdown in the economy or a potential recession, which I don't think we're going to get, so those are some of the names that actually will perform pretty well. So I think it's also a little bit of a safety trade, and it's unusual that you would go to tech for that, but I think that's what's going on.
There's also plenty of stocks still trading at levels that are attractive. And of course, you want to wait and see exactly how the scenario plays out. But what other sectors would you be looking at for some of these deals?
So we like tech, but we like quality across the board. I think this is, besides stocks, I think this is a good year also for bonds. And so I think interest rates will end up going down at some point. I'm not sure if the futures market is correct and that we're going to get reductions in the fall like the investors are predicting. But I think bonds are going to do pretty well. I also like international stocks. I think the EFA beating S&P 500 last year, beating the U.S. stock market this year. I think that trend could continue to go on. So I like that as well. And so I think sticking to quality across the board, companies that are creating cash flow, great idea. And we've lightened up on our energy overweights, and so we don't really have a big overweight in energy anymore like we did last year. And I think investors can look at growth again, but don't chase index returns and by trying to find the names that they think are going to go up the most. That's not the way to do it this year.
When you think about the debt ceiling, is this largely a lot of noise? Do you think a deal will be made? What should investors be concerned about, or perhaps not concerned at all?
If you're a long-term investor, certainly it's something that you should be paying attention to. But should you be trying to market time whether there's a deal or not? Let's just say that we get past a deadline and like we did in 11, and you get a downgrade like we did on our treasuries. It'll still be a short-term event. Now, I think the rhetoric coming from the government, I don't think anybody wants to risk that, especially at this time, in the markets and economy, just too fragile. So I think the politicians and hopefully the cooler heads will prevail, and the politicians will work out a deal before we go over the cliff in a sense. But still, even if we do, I think it's going to be a short-term blip. If anything, it's going to be a trading opportunity for traders.
What are your thoughts about the consumer and how they are performing relative to the inflationary environment?
All the estimates that we had and the data that we've been researching over the last 12 months showed us that the consumer was going to run out of stimulus money around summertime. And I think that's what we're seeing now. In the lower end of the consumer, has been probably out of cash for a little while now. But I can tell you with a lot of anecdotal evidence with clients at our firm and just talking to a lot of friends that are advisors and also just consumers, there's more cash on the books right now on balance sheets and in bank accounts than I've ever seen. And whether it's mass affluent or high net worth, there's a lot of money that I think when the sentiment shifts from negative to where maybe we don't go into recession, that I think could be going into risk assets like equities.
All right, Jimmy, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you for having me on.